Hey everyone, welcome back to Corporate Decoder. Today we're diving into Graham Corporation's latest 10K filing. And let me tell you, after reading this report, I feel like I need ejector seat technology of my own. And before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can share your opinion. This report is basically a yearly health check for the company, covering everything from their business strategy to potential risks. So what's the headline? Graham Corporation, a company making specialized equipment for industries like defense, energy, and even space, is trying to become less reliant on the cyclical energy sector and focus more on defense. But how is that working for them? First, let's get a handle on what Graham Corporation actually does. They design and manufacture custom engineered vacuum, heat transfer, and fluid technologies. Think of them as the guys who build the critical components that keep big systems running smoothly, whether it's a nuclear submarine or an oil refinery. They have facilities in New York, Colorado, China, and India. And then late 2023, they acquired P3 Technologies, a company that specializes in turbo machinery. Management believe this acquisition advances their growth strategy, further diversifies our market and product offerings, and broadens our turbo machinery solutions. Graham has shifted its focus to markets with lasting demand, where their expertise can command higher profit margins. This transformation is aimed at creating more reliable, recurring business and long-term growth. They're aiming for 8% to 10% yearly revenue growth with healthy profit margins by 2027, which they hope to achieve through a full lifecycle product model and synergies between their business units. But it's not all smooth sailing. One potential risk is increasing reliance on the US Navy, which makes up a large portion of their defense contracts. Any hiccups in government funding or changes in defense spending could throw a wrench in their plans. Adding to the uncertainty, government efforts to cut the federal budget could lead to cutbacks in defense and alternative energy projects, which could decrease demand for their products. The business has contracts that can run for years but can be impacted by disruption of funding. Since this business is expected to remain significant as a percentage of our overall business, such a disruption, should it occur, could adversely impact the sales and profitability of our business. Another challenge is their reliance on fixed price contracts. If costs increase unexpectedly or if there are delays, it can eat into their profitability. Certain US government procurement policies also leave Graham carrying risks that exceed the value of their insurance coverage. In the commercial space, the business is not very different. The company faces tough competition from larger companies in both domestic and international markets. The company's main strengths are their engineering capabilities, ability to handle custom orders, and maintain a flexible, responsive production environment. Before we dive into the numbers, here is a quick scroll to one of the last pages. If you want to know who are the leaders that are in charge, you can scroll all the way to part 3 because they are incorporated by reference into part 4, items 10, where this report. Now let's check out the financial numbers and see what's really going on. For the year, the company's net sales were up about 13% to $209 on Neil million. In the bulk of that increase came from their defense business, offset slightly by decreases in aftermarket sales. Looking at profits, gross profit margin improved to 25.2%, up from 21.9% the previous year. This reflects efficiencies, higher sales volumes, and better pricing. However, selling general and administrative expenses, or SG&A, also increased, largely due to strategic investments in people, processes, and technology. Ultimately, net income was $12.2 million, up considerably from $4.6 million the previous year. To show a more fair picture, we need to adjust the number. The so-called adjusted net income reached $13.7 million, or 1.24 cents per share, up from $6.8 million, or 0.63 cents per share. Orders booked came in at $231 million in dollars mentioned before. The company's defense business is up, so it is responsible for a large percentage of orders, $12 million. Most of their sales are in the United States, but there is a notable increase in international sales by 35%. Also, sales to the defense industry accounts for the lion's share of their business, 58%. Now, let's discuss the strategy forward. For the upcoming fiscal year, the business expects to see continued improvements in revenue and adjusted EBITDA, although with certain caveats. The company expects to spend around 2% more due to implementation of new radiographic testing equipment. They also expect that the impact of increased tariffs will cost around $25 million. Of course, there are also risks. Like every business, Graham faces cybersecurity threats. A successful attack could result in financial losses, damage to their reputation, or theft of valuable intellectual property. They are also implementing a new enterprise resource planning or ERP system which can be complex and carries risks of disruption. Now, let's touch on some of the market risks the company faces. Because they operate globally, they are affected by currency fluctuations and trade policies. Changes in interest rates can also impact their borrowing costs. As we see, there is actually interest income, not expense, which means the company makes more in interest than it spends on debt. This is due to a strong cash position and lower debt levels compared to the prior year. Another risk worth noting, business in China. The evolving economic, political, and social conditions in China could affect their operations there. Finally, taking a look at the balance sheet, we see that the company's total stockholders' equity, which is what would be left after selling everything and paying off debt, is up over 13% to nearly $120 million. This is where the rubber hits the road. This report confirms whether the business is painting a fair picture of their true financial standing. While not a guarantee, these types of reviews help reduce the chance of a complete fabrication of financials. It seems that, at least according to the third-party auditors, the financials are presented fairly in all material respects, the financial position of the company. So, at least for now, they are fine. It seems like this audit team is in line with public guidance regarding cybersecurity, with a review of what they are doing to mitigate risk and improve it. Scroll, I'm not sure if this is actually that important, but I do think it is something to be aware about in general, that if companies report a low to mid-teens adjusted EBITDA, you should really question what is being excluded. In that sense, what they are doing it isn't necessarily wrong by law, but that doesn't mean it gives a good picture of how healthy the company really is. Olfen, so what's the verdict on Grand Corporation? It seems like the company is making progress in its transformation. The diversification into defense has provided stability, and the company's focus on its competitive advantages such as engineering expertise and ability to handle custom orders should continue to help the business to grow their profits. However, risks related to their reliance on the US Navy and the cyclical nature of their end markets are real. Overall, the numbers appear to support management claims, so it seems okay for now. This is not financial advice. See you next time. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.